Hello learners, I will be continuing with the rest of accounting terminologies in this video. First one is liability. Liabilities are the obligations or debts payable by the business in future in the form of money or goods. For example, Mr. A has purchased goods on credit from Mr. Z worth $10,000. In this case, Mr. A has a liability of $10,000. Another example is, let's say Mr. C borrowed $1,000 from Mr. D. So, this becomes a liability for Mr. C. Next term is financial statements. Statements prepared by an enterprise at the end of accounting year to assess the status of income and assets is termed as financial statement. It is a formal record of all the financial activities and position of a business, person, or other entities. A balance sheet or statement of financial position reports on a company's assets, liabilities, and owner's equity at a given point of time. It basically includes two statements, that is, income statement and position statement. Next term is goods. Goods are the commodities in which a business deals. In other words, articles purchased for sale at a profit, or for processing by the business, or for the use in the manufacturing of certain other goods as raw materials are known as goods. Moving further, next term is stock. Stock means the goods which are available with the business on a particular date. Now, stock can be of raw materials, work in progress, and finished goods. Raw materials are the material or substances used in the primary production or manufacturing of goods. Work in progress refers to raw materials, labor, and overhead cost incurred for products that are at various stages of the production process. When the good is completed as to manufacturing but not yet sold or distributed to the end user, it is called a finished good. Next term is debtors. The person from whom amount is due for the goods sold or the services rendered or in any aspect of contractual obligation is called debtor. For example, Mr. A has purchased goods worth $10,000 from Mr. Z. In this case, the amount is due from Mr. A to Mr. Z. Mr. A is a debtor in this case. The total amount due from debtors is called book debt. These are shown under the current asset head in the balance sheet. Next one is creditors. The person to whom amount is owed by the business on account of goods purchased or services rendered or in respect of contractual obligation is known as creditor. In the previous example, the amount is due to Mr. Z by Mr. A, so Mr. Z is a creditor. The creditors are collectively known as trade creditors. These are shown under the current liability head in the balance sheet. Next term is expenditure. Expenditure is the amount spent on liability incurred for the value received, like goods, assets purchased, or services availed. It may be classified into three categories, that is, capital expenditure, revenue expenditure, and deferred revenue expenditure. Let's talk about capital expenditure. The payment made for the purchase of fixed assets or payment of long-term liability is known as capital expenditure. The benefits of such expenditure are derived in future. It is non-recurring in nature and increases the earning capacity of the business. Some of the common examples are purchase of land and building, payment of long-term loans, etc. Moving on to revenue expenditure, The amount incurred for the purchase of goods or services which are consumed during the current period is called revenue expenditure. The benefits of such expenditure are normally utilized in current period. This expenditure is recurring in nature. Some of the common examples are salaries paid, insurance paid, purchase of goods, etc. And the last term is deferred revenue expenditure. Deferred revenue expenditure is an expenditure which is revenue in nature and incurred during an accounting period. Its benefits are to be derived over a number of following accounting periods. The common examples are advertisement suspense account, discount on issue of shares and debentures, preliminary expenses. These expenses are shown on the asset side of the balance sheet. Thank you.